today to make this happen. So let's just make sure that does happen.
At least you dressed today. No hoodie.
Thank you. All right, yeah, looks like we're streaming automatically. I'm just going to check with my partner over here. Am I streaming okay everywhere? 50 people have joined already. And so just
Anybody noteworthy?
huh?
Anyone noteworthy?
Oh, probably everybody. Yes, I think so. Yeah, it's quite a noteworthy crew. Right. Welcome, everybody. Thank you so much for joining us today. I am Adam Gower, and I'm still fiddling with all my controls here. Sorry about that. I am Adam Gower, founder of gowercrowd.com. We build digital marketing platforms, aka crowdfunding platforms for commercial real estate professionals, sponsors, so that they can raise more capital from individual usually accredited investors. Our clients have in excess of $35 billion of assets under management, and they've raised hundreds of millions of dollars using our systems. Thank you so much for joining us. Today, you're going to be hearing from 4 seasoned real estate professionals who are going to provide insights into the legal, tax, and ethical implications that are facing investors, passive investors, and sponsors in today's market. I'll introduce them briefly now, but I'm going to let them do their own introduction a little bit later. Mark Roderick is our lawyer. Of course, the title I thought was quite a catchy title. I hope you agree. A lawyer, an accountant, and a real estate investor. We've got 2 investors walk into a bar. So Mark Roderick is our attorney. Tom Castelli is our CPA, who specializes in commercial who specializes in tax laws pertaining to real estate. Irwin Boris, who is with the Heritage Capital Group, a 3rd generation family office specializing in industrial real estate. And Joe Blackbourn, a good friend, president of Everest Holdings, who has several funds, including a preferred equity fund. So you're going to hear some very interesting insights from me. I had a very interesting dinner last night. We were chatting about it a little bit earlier. I'm going to ask him to share some of the insights he gained from that last night. Now, I'm going to let them all introduce themselves in a moment. But first, I want to tee up the discussion that we're going to be having today with some background. So this entire event was inspired by a conversation that I had with a passive investor, right? It was a lady who had invested basically all of her life savings with a well-known, highly visible sponsor, and who is it's about $500,000. She was very emotional on the call, actually, and asked me to help. And I couldn't think how I could help other than to put together something like this to provide guidance and insights into what's going on in the world. But she'd invested in 5 or 6, 2 funds of this sponsor, and 3 or 4 individual deals. And all had gone swimmingly well until distributions were shut off completely. Communication with the sponsor, who had originally been charming and invited her in, suddenly stopped. And she started getting kind of fobbed off on IR personnel who discussed what was going on over there in extremely complicated technical terms. Overwhelming. They were being overwhelmed. She was being overwhelmed with details that she clearly couldn't understand. But what was particularly alarming to her and upsetting was that she was seeing on Facebook this same sponsor, and I'm out of all discretion, I'm not going to share names with you today, but I am looking at an ad here on Facebook. And this was one of the ads that she saw that really upset her. She said, access, and so I'm going to read some of this to you. access to full cycle deals. Oh, across a certain number of full cycle deals, this sponsor says we have delivered an average 32% growth in NOI, resulting in 22.7% average net investor IRR. So she's seeing on Facebook this same sponsor who's stopped distributions on her entire life savings, and is what's it called? Smoke screening her with jargon when she asks what's going on, raising more money, but also professing a full cycle. I think this is the key for the ad, Mark. When we get to you, I'll certainly ask you about this. Full cycle experience with some incredibly high IRR. And seasoned investors choose this sponsor. Go back to multifamily investing basics. So that's kind of the context for why we're here today. These things that are going on in the market that have never really been possible on such a wide scale. Mark, particularly, right? The crowdfunding world, or general solicitation, is probably the more accurate term for that. And then there's another thing that I wanted to mention as well, Mark, just to tee up everything. These are not the only guys who are advertising the same kind of, to what extent is this misleading information online? But actually, we'll come to the guaranteed question later. I'll ask you about guarantees later. So why don't we kick off? That's the background. That's why we're here. From a sponsor's perspective, an investor's perspective in commercial real estate. Let's go around the table. Let's go in the order of the event. Lawyer, accountant, and investor. Mark, Roderick. Crowdfundingattorney.com. Actually, Mark, as I mentioned before, has an amazing blog, and so does Tom Castelli. They are in the chat. So do please feel free. Go ahead and look at those chats. Sign up for their blogs. They're really good. I read, there are very few blogs that I read when they come in from beginning to end. I always read Mark's and Tom's. So go ahead and sign up for those. They're in the chat. Mark, this scenario with this investor who's basically been told she's lost the money, seeing these ads, what's going on here?
Well, first I will say, you just explained why whenever I talk to you, you seem so sleepy. I thought it might be a thyroid issue, but it's obviously reading my blog that is getting to you. And second, I mean, she should have invested in Truth Social. That's really that's where the money is.
At least for the first few weeks, anyway.
So it is, her blood pressure is way up when she sees what she believes or even knows to be false advertising.
Well, hang on, I'm going to jump. Is it false though? We have completed.
I was just going to tell you it was.
Okay.
Okay. It is false. It is false. Even though, from the sponsor's perspective, and perhaps speaking with the sponsor's mafia lawyer, they decided, oh, well, this is really truthful, because even though that project is about to go back to the bank and become a full cycle project that we'd have to include, it hasn't gone back yet, so we don't have to include it. It is still fraudulent. It is a misleading statement. A misleading statement is something you say, in fact, to quote, Rule 10b-5, sort of, if you omit information that would be necessary to make what you've said not misleading, that is fraud. And this is a classic example, okay? We have 27 projects with an IRR of 28.6. Oh, we have one project where everyone lost their money, but we're not going to tell you about that. An omission is as fraudulent for all legal purposes as a outright lie. And even though the statute of limitations under Section 10b-5 could have run, common law fraud claims can be made. So great, they committed fraud. Oh, she's pissed off about it. Wonderful. There's nothing she can do. The sponsor in your hypothetical is defrauding new investors, people who are putting in money in reliance on that misstatement. But she didn't rely on that misstatement when she invested. So this scenario doesn't give rise to a claim by her, which makes her sad. However, as we were saying earlier, my experience is that sponsors who will say this now, probably the same people with the same business ethics would have said it 3 years ago or 2 years ago or whenever it was she invested. So if I were she, I would go back, I would hire a competent securities lawyer, one who's been around long enough to become terribly cynical, and have him or her reread the offering materials that she was given. And I would strongly suspect they are going to find something in there that would provide a basis for her making a claim. So their current statements, they can lie all they want. They can say, if you invest with us, the sun will rise in the west tomorrow. But that doesn't give her any claim. She has to go back and find something that they lied to her about and that she relied on or can claim to have relied on when she wrote her check.
So what advice, and Joe, actually, I am going to go out of order, of course, of our agenda today a little bit. So what advice would you give to so that's advice you give to investors, but to sponsors? And Joe, this talks about communication. We'll get to you in a moment about communication. But Mark, communication. What advice do you give to sponsors then who are actively trying to raise money for new deals, but who do have these problem assets in their portfolio? How do they communicate that? I mean, how do you market effectively if you are harbinger of bad news at the same time?
Well,
are you asking me or Mark? I'm sorry.
I'm sorry. Are there two?
Yeah,
Marks
Mark first, and then Joe. Then Joe.
Yeah.
Okay. I'm
From
sorry.
a legal perspective, like, what do you need to do?
Yes. So the reason I earn the low wages of a lawyer and not the high wages of a marketing person is that I'm not an expert to answer that question. However, I will say that telling the truth does have certain tangible and intangible benefits. And the first communication, although you didn't ask for it, I think everyone here, well, I'll say it anyway, even if everyone here strongly disagrees. Communicating with your existing investors about their bad deals is so important. It is so important to keep your investors fully informed, even if you're sending them bad news after bad news. Investors who are in the dark, no information, rumors, get so angry and they hire lawyers. And nothing good ever came of hiring a lawyer. So the communication with the existing investors that is paramount. The communication with the new investors can be truthful. I mean, many sponsors, including maybe those on the phone with us today, have problem projects because of events none of them could conceivably have anticipated, in particular COVID. No one anticipated COVID. No one can. The risk factors that the lawyers thought up over 2,000 years didn't say anything about COVID. No one saw it coming. So you can be truthful about, listen, this project was here and it was in the middle of a city where there used to be 5 million office workers and they wanted to live near their office. It was perfect. COVID hit. Everyone abandoned their office. They've come back to some extent, but are never going to all the way come back. that's why this project is a problem. And that truthfulness, but this new project doesn't have that problem. It's evasiveness that people can sense. Everyone can sense evasiveness, especially plaintiffs' lawyers. So you can absolutely have a positive marketing message, even while you are experiencing difficult projects and being honest with those investors. That's my response.
Yeah. Thanks, Mark. Joe, we've talked about communication. So why don't you introduce yourself briefly, what you do there at Everest, if you would, please. And then let's talk about communication in the context of what's going on with this lady and her sponsor.
Sure. I'm Joe Blackbourn. I'm in Arizona. I run an investment company. We do a variety of things in the context of real estate, from debt to equity to development. And so what? And
don't tell the SEC you run an investment company. Don't use that word. That you can't be an investment company. You do. So just.
It's like you get a bill later. You're going to get a bill later.
Okay. So in any case, I just like to, I guess that a lot of this seems complicated and a lot of it is simple. And the simple part, and I'm an old guy in the business. I've been doing this for decades. And the simple part is there's nothing that requires a higher standard of care than asking for people's money and taking care of it. And you have to, as a sponsor, first and foremost, you have to prioritize truth, disclosure, identifying risk factors, and communication. And Adam, you and I have talked about this many times. There are very few in this business. If you've been in the business as long as I have, you experience losses. And if in certain types of businesses, now Irwin is in a cash flow type of business, he's very protective of safety. And a lot of this business that you're talking about in this syndicated format is IRR based, and it inherently brings risk. And if you have cycle risk, which you do in an IRR driven investment platform, things like COVID, things like the rate shock we're experiencing now are very difficult to escape in terms of what the problems that occur. And my mentors in the business from when I was a kid always said, and we are in a difficult time now. Now is the time when people show their character. And it's, once again, back to what's simple. That's the simple piece. You speak to investors honestly. If things are going poorly, you tell them right away. And then you work your ass off to return every dollar in a way that's prudent and thoughtful and cognizant of risk. And sometimes it doesn't turn out great at the end of the day. And sometimes you're able to return everybody's money and their return. But we're in one of those times right now. This is really challenging. I just recently put together a presentation. I'm going to be speaking at Urban Land Institute in New York next week. And the title is Underdressed Weatherman Reports from the Hurricane About Multifamily Challenges and Opportunities in U.S. Growth Markets. And just to give you a sense for how I feel, it's like there's this storm out in the middle of the Atlantic. The question is going to be where and at what strength it hits markets across the Sun Belt in the country. So I'll stop there.
Yeah, but the other thing that you and I have discussed is the idea that real estate is a long game, and if you are forthright, I'll let you discuss that. I'm just going to prompt you though. If you're forthright today, even in the challenges you have, and you do your best, the fact is that the market will come back, and you will want to return to those investors. So just talk about that kind of long-term perspective of, wanting to survive to another day. Even if you lose money, you're going to want to be raising money again. And how does being honest and forthright today help you with that?
I think one of the biggest measures of success over a long period of time is that investors that might not have done great on every deal with you invest with you again, because they feel like you have had a good level of character. You've done everything that you can possibly do. when we talk to people, back to, the representations that you can make about your track record and all of that, I don't have a problem saying that we've weathered some storms and we've had to dig in and operate at a level that only experience can bring in terms of solving problems. Because it's not just, when I say some things have changed and some things are the same, the way people raise money has changed. It just has, and it's, as you say, it's much broader in terms of the exposure to accredited and non-accredited investors. But the operating piece of the business is the same. You still have to block and tackle and take care of things and get to boots on the ground in order to protect people's money. And so and I'm going to say this overgeneralize, but these young people who are raising boatloads of money, we in the industry all look around and say, wow, that's actually pretty impressive. What it allows them to be able to do is pretty impressive. I can't do it. You and I have talked about it, but I don't think many of them are experienced in managing through difficult times like we're experiencing now, where you're getting squeezed by the capital markets. We're creating some oversupply in the actual fundamentals, and prices are dropping, because of this rate environment. And then what do?
Joe, right? I have to interrupt you. I'm going to interrupt you because you said you can't do it. Actually, the fact is that guys like you and Irwin actually can do it. The challenge in the context of what we're talking about today, challenge that you have is not being hypey, right? And so what's actually happening is that when you go forward into the market with the same kind of marketing and tactics and techniques, that's what we do, right? We build these systems for sponsors.
Right.
The problem is that the noise that's out there is this noise that's coming from people who don't really understand what happens during a downturn. And so they're less reticent to be, how many negatives I'm going to put into this sentence? They are not reticent about being hyperbolic, right? In talking amazing track records and just playing with words and using hype. Irwin, why don't you comment on that as well, if you don't mind? Irwin, just a brief, just to highlight who is Heritage Capital Group, and what are you seeing in the market with new sponsors and
Sure.
that they're raising? Yeah.
Irwin, Boris, Heritage Capital. I've been doing this a long time. Background as an accountant, being a lender, and now as a sponsor. And the way I look at a lot of these guys out there raising capital now, back in 08, 9, 10, 11, these guys were either in college or in high school. So they've never seen how bad things can get, how to prepare. And as prices continued to escalate and cap rates compressed and interest rates went up, they just became a lot more creative in how they underwrote the deals in order to generate an IRR. It was a manipulation of numbers. We've never, actually I should say never, but in the last 5 or 6 years, I don't think we've leveraged more than 60 or 65% just to have some cushion if you lose some tenants. What if insurance spikes? What if real estate taxes going up? And no one could have predicted COVID and the interest rate hikes. And now with the insurance, going from $250 a door to $1,100 or $1,200 a door on some of the multifamily projects with the supply chain issues created by COVID. And actually, this particular sponsor you were referencing to, Adam, I actually saw their ad and I was curious to see, what the Kool-Aid was. So I got on a call with their investor relations person about the new fund that they're raising. And I said, my first question was, tell me about all the deals that you're not distributing on. And his response was, oh, you know about those? I said, everybody knows about those. And he said to me, well, we're accumulating cash because we have to replace interest rate caps. And all right, so that's logical, because there's another sponsor that has $250 million on watch list because they're on 1.0 coverage with the agencies, and they're probably doing the same thing. And I said, well, what has this all taught you people? Well, we need to control not that we shouldn't over leverage, or not that we shouldn't screw the model down so tight, or we shouldn't use floating rate debt. The response was, we need to control the supply chain so we can always renovate the apartments on time. That was the response. And I'm like, yeah, you need to control, but it's a combination of things. I'm sure the supply chain wasn't the only thing that hammered you, but it was just kind of interesting to see what they say. And then when you're going to screen a sponsor, you can put the name of every sponsor in the search bar at Google and look for troubled loans, loans in default, or investor complaints, or deals not distributing, and they'll all come up. So whether you want to be honest with people about your track record, and yeah, I guess it's a play on words. We haven't given it back yet, so it's sort of teetering, but it's not part of our track record because it's not 100% full cycle yet. I understand that, but I think you have to disclose good and bad to people.
So that's a very good point you make there, Irwin. It's the information isn't perfect, but it's definitely available online.
Correct.
To investors. So
it is available, and I look at I look at what's in the Facebook feed and Instagram feed, and not only is it all these guys promoting mid to upper 20s IRRs and 9 pref, and some people think 9 pref they're going to get 9 on their money. I think Grant Cardone was sued in his Reg A for people that thought they were getting that preferred return, and they weren't, because they didn't read the document. So maybe that was the way that was cleverly worded. But I'm also seeing a lot of capital raising boot camps in schools, and they're like looking at Oren Klaff's book and teaching part of that. They're pulling that stuff from Robert Cialdini on the psychology of influence. They're just trying to figure, how do we get the money? But it doesn't mean that the sponsors know what they're doing, because they're all so young. And so, there's a lot of capital that's being raised by these people, and it's great for them, but I can't operate that way. I just can't.
That's right. You have, I know you have 6 million square feet of industrial, about $750,000 million of assets under management. Tom, let's just move to you briefly. I'm a huge fan of yours, Tom. I'm a huge fan of everybody's here, but I'm not. I've always avoided tax.
Yeah.
Not avoided. No, let me say that right. I've not avoided. I have, but I've always avoided trying to learn.
You can avoid, you just can't
evade.
That's
yes, thank you.
Yes.
I've avoided even learning about it, but you've made it a pleasure. And so I just will reiterate, if anyone on the call, thanks for joining anyway, everybody. Just look at the chat. You'll see a couple of blogs here, both Mark's and Tom's. If you've not done so already, I do recommend you sign up for those. They're really good. You can always unsubscribe, of course. But Tom's is particularly good. Tom, CPA specializing in real estate tax laws. Let's just look at the kind of the bleak scenario here. So somebody does actually get a note, distributions stopped is one thing, but gets a note that says, listen, your equity stake in this deal has been wiped out. Yeah. So there's no equity left. What are the tax implications? Forgot to introduce yourself briefly. And Samuel, I do see people putting their hands up. I've got no clue how to actually respond to that. So if you've got a question, I have too many things on my screen. If you've got a question, Samuel, please go ahead and put it in the Q&A, and I'll try and get to it if we've got time. Tom, over to you. Who are you? What do you do? What's your expertise? And what are the implications from a tax perspective getting that kind of notice?
Yeah, absolutely. So my name is Thomas Castelli. I'm a CPA. I work with real estate investors across the U.S. The firm that I'm with, Hall CPA, we work with investors with as little as one property all the way up to syndicates and funds. We have an entire private equity division that specializes in syndicates and funds and the related tax issues. I'm also a passive investor myself, had been a limited partner on a number of deals. So that's just a little bit about me. Coming into this, so what happens with a loss, right? So this is actually incredibly nuanced, how a loss is treated. I know I briefly discussed it before we jumped on, but I did pull up my notes to go through the details. Okay, so there's two different, really at the end of the day, there's two different fact patterns that you could be facing as a limited partner when you're facing a loss. If it's a total loss of your investment and there's no sale or anything like that, there is under revenue ruling 9380, where that could be treated as an ordinary loss because you're effectively your investment went bust, right? There's just nothing left, right? In that case, it could be an ordinary loss, and that would be deducted against your ordinary income. For example, if you have income from a job or business, whatever the case may be there. So that's that's under, again, that's Rev ruling 9380. If there's a total loss and there's no distributions, there's no deemed distributions, there's no sale or resemblance of a sale, then your investment in that limited partnership would be generally non-passive. And if that's the case, if that's a case for you, or you believe there's a case for you, I highly recommend speaking to your CPA, your attorney, your tax advisors, just to be sure how that's treated and make sure you're dotting your T's and crossing your I's, because I've seen this before and it's just incredibly nuanced. So you just want to make sure that if you believe this to be the case, that you're contacting the proper people, because you don't want to get this wrong. But the bottom line is, what I'm saying is, if there's no distribution, there's no sale, there's no nothing, you just have a total loss of your investment, it could be treated as non-passive. Or
how does that come to you, Tom? Does that come through a K1? If you get a K1 that says what, negative 100,000, if that's what your investment was, how does that work exactly?
Well, in that case, typically, in that case, so if you have a deemed distribution, if there is a sale of the actual property and you do have a loss in that case, this would be generally a capital loss. If there's a true loss, if it's capital in nature, then you're subject to the capital loss rules, or the capital gains rules, which state that you can take up to $3,000 of a capital loss in a given period, or then it's going to be carried forward to future years beyond that, or offset your capital losses if you have capital gains for the year. But that would come through a K1 in that situation.
So capital losses can only offset capital gains. They can't offset ordinary income, and only $3,000 a year. So if you invest 100,000, you have 30 years before you burn it off.
Well, so the capital gain losses can offset capital gains. So say, just for the sake of example here, you had $100,000 capital loss, right? In that case, the $100,000 capital loss would offset any capital gains you have. There's no limitation to that. So if you had $200,000 capital gain, maybe you sold a stock, maybe you had another investment, whatever the case is, that you could use then the entire loss because you have enough gain to offset it. However, if you have loss in excess of your capital gains, only up to $3,000 per year can be offset against your ordinary income. If not, it will carry forward to future years where that capital loss can be used to offset other capital gains that you might have in those future years.
I have a question for you. What about recapture of depreciation or phantom income from forgiveness of debt if the lender decides to ding you with that?
Yeah, that's a great question. From recapture specifically, and I know we talked about this a little bit before the show. When it comes to recapture, most circumstances, if you are selling at a loss, there will not be recapture in most cases. However, there are scenarios, and I'll give a big number here. Say you buy 100,
like a foreclosure, there is no sale, so it's foreclosed.
Yeah, go ahead, Tom. Go ahead with your chain of thought.
So the $100 million, say you had $100 million property, right? And usually when you have a syndicate, there's going to be bonus depreciation, cost segregation studies, all that good stuff that's going to reduce what's known as your adjusted basis. So what happens is you have this $100 million property, that's your purchase price. Then you take this $20 million of depreciation or losses, right, from this particular property. And then your adjusted basis is going to be, at that point, $80 million, right? So if you were to sell that property for $90 million, well, you technically have, in reality, there's a loss, quote unquote, right? But for tax purposes, you actually have a gain of $10 million, and that would be subject to depreciation recapture. And that's because while you were selling it below your purchase price, you're selling it above your adjusted basis thanks to depreciation. So in most cases, this usually does not occur, but it can occur. And this is the reason why I'm mentioning it now. So to answer the question, is there depreciation recapture? It depends. In most cases, there won't. In some cases, there might be. So you just need to get with your sponsor. And that would be generally on the K1. That you would find the depreciation recapture, and that would come through on your K1 if that's the circumstances. As for forgiveness of debt, that's a little bit more nuanced that I'm prepared to dive into today. But I have to look into the regulations on that to see specifically how that's handled. But there could be implications there. If there is forgiveness of debt, there could be gain. And that's what you're referring to as the phantom income. And that could occur.
Tom, thank you. I just want to make this point, by the way. So for all the people who are on the call, working with an accountant who knows their stuff in real estate is really, really important. Because I mentioned before we started, I've actually come to that realization at my own cost. So definitely, look up. I don't want to plug everybody on the call, but particularly, I think an accountant. You should make sure you're in touch with Tom afterwards. If your accountant can't answer the questions, Tom or Mark will be able to help you. All right, listen, I want to move to a different topic. Somebody has asked some questions that I very, very specifically want to answer. And they actually dovetail very well into the next theme of what we're talking about. So pref equity. So let me kind of line this up a little bit. Joe, you've got a pref equity fund, and you go out and you find sponsors who need some rescue capital. If you pardon me using that term, right? To invest pref equity. But what we have also seen starting to happen is sponsors. And in fact, this one sponsor that I mentioned at the top of the hour when we started, who triggered this whole event, whose investor contacted me and said, I'm seeing these ads on Facebook about their wonderful track record, and yet my distributions have all stopped, is a good example of this same thing, where what they do is they set up now, having these troubled assets, they set up a pref equity fund, a preferred equity fund, that they then start to pitch as being a great new opportunity to invest in real estate, get a 15, 18% IRR, and they go out, they raise money for that is then used in part to salvage their own deals. So we got a question here from somebody in the audience who says like this. So let's see. When a GP does that, when a sponsor sets up a pref equity fund to salvage a deal that's going bad, shouldn't that sponsor first bring the opportunity to invest in the pref equity to their existing investors? And what she says here is, when I asked why they didn't do that, they said they didn't want to do that to the LPs. So she asked what were the terms for the pref equity, and they weren't shared with her. So not even sure how to ask the question. What's your reaction? Let's start, Mark. We've not heard from you since the beginning, and then we'll go to.
You and I actually did an entire podcast that I think went viral and is now as popular as Korean pop music, as I've heard, on this very topic of what happens when you don't have enough money. How do you, what do you do? And the key there was your operating agreement should provide for that contingency. It should not leave it blank. And what I always do is, say that the sponsor is allowed to go out and raise money using a new security, and typically it is some kind of preferred equity. But the sponsor, to be fair, has to offer that new equity to the existing LPs first. And of course, we're using the term LP, which stands for limited partnership, generically to mean investors, because these days everything is a LLC that doesn't have limited partners as such. So that's what it boils down to. You have to look at your operating agreement. And if I were she, I would look at the operating agreement, and she may have a claim that the sponsor is simply not allowed to do this. And that is true in many operating agreements. It should never be true in any operating agreement. But during the good times that we've had, people, we'll never need to raise money, everything's going to go great. So the lawyers leave it out of the operating agreement. So the sponsor may be in a real quandary right now and doing something that it is not actually allowed to do. Now, I don't know why. Let's assume that they are allowed to do it. I don't know why a sponsor would choose not, if it's offering preferred equity investment, why it would not offer that investment to existing investors, maybe our developers on our panel will be able to answer that question. But
maybe it signals, if you bring in pref equity. Joe, I'd like to ask you to chip in here as well, because this is something you and I have talked about. When you bring in pref equity, you really are either you're doing something ghastly to the existing investors. So
not always.
Okay.
No, you're not. You're often saving the deal for the benefit of everyone.
And that's why it's called rescue capital.
Yeah. And you need to be able to do it. That's why the operating agreement should provide for it. Because what can happen otherwise, if your hands are tied as a sponsor and you theoretically need the consent of all your LPs, somebody's going to hold out for a better deal, and the whole deal can crash and burn just because you didn't have the right provision. So you're really not taking, if it's a fair deal, you're not taking advantage of them.
Ethical, Joe, to go to not to invite existing investors to take a pref equity piece in a deal. Like, why would you not go to, like Mark said, why would you not go to your existing investors and offer them the opportunity first before going to outside investors?
I can't imagine why you wouldn't, but every deal is different. But I 100% agree with what Mark said. It's even if it isn't provided for in the operating agreement, and I think it should be provided for, you should, and should is obviously a pretty squishy word, communicate to your investors that the deal needs an injection of new capital and why, and model a path forward financially and offer them an opportunity. And yes, there is a danger that not everyone will agree, but you'll have to amend the operating agreement in order to get that done. And if it's the right thing to do, generally, not always, but generally you should be able to get there. And to clarify, we don't have a pref equity fund. We make pref equity investments on a deal by deal basis. And generally it's in a set of circumstances where a sponsor needs to recapitalize the deal, and there is room to do so and return the LP money. And that it is a better scenario. They're not going to do it unless it's a better scenario economically in their minds than selling it today, or injecting new or injecting new LP money at whatever the cost that is.
Yeah, it's definitely interesting to see the way that deals are being salvaged and being marketed. It gets back to this idea of putting together a fund but not being clear that it's actually a fund to salvage salvage your own deals. And that is what is different, I think, today than has been possible before, really.
We would not look at making a loan to one of our own entities with a different entity. I do believe that there are conflicts associated with that I don't want. I don't want an entity we manage to be a counterparty at any future date.
Yeah, and I just want to note that Joe, he's allowed to do it legally, but I've never met Joe before today, but he is a reputable sponsor. In what he just said, he doesn't want the conflict, the appearance of the conflict. He wants everything to be above board completely, and that's the kind of sponsor you want to invest
be dealing with. Exactly.
Who does the right things. That's it right there. Character matters.
Right. So I'm going through all these Q&As here. Tom, you'd be happy to know that there's an enormous amount of tax questions. That does not surprise me in the least, actually. And that is why you should sign up for Tom's blog. Apparently, the chat is disabled, only for me, though. So I'm going to go ahead. Let me just read those to you now. Gosh, I wish, I don't know. Can anybody see? You can't see the Q. Can only I see the Q&A, or can everybody see?
No, I can see it too.
Yeah. Can our guests, also attendees, also see? Somebody just pop, if you can see the If you can see the Q&A, somebody just pop into the Q&A. Yes, we can see the Q&A. And in that case, I'll put these links in there. But I do want to move on to another topic that's come up and quite visible recently. It's kind of a fun one. Question of guarantees. So we did talk about this. I'm looking at this other ad on Facebook. Gotta love Facebook, right? It's the wild, wild west. Guest cannot see. Okay. All right. Sorry. I'll read off these. I'll tell you what, I will email you afterwards the links to these blogs. All right. So you get an email from me soon. You can sign up if you wish to. So here I'm looking at an ad here on FaceChat from a very well-known, highly visible sponsor. Irwin, let me start with you on this one. All right, now you've got that wonderful background there behind you. It says, do you want higher returns with less risk? Considered preferred equity investing. Oh, it's still a pref equity thing. Get priority payouts and a comfortable position in the company's capital structure. Guaranteed cash flow from day one. Keyword guaranteed. How do you react to that, Irwin, Boris?
I laugh. I laugh because it's not guaranteed. Yes, you have a senior position to the common equity or the other investors. You know, after the lender, you get what's left. So is it guaranteed? No. Is it more of a higher priority? Yes. So I think it's misleading. It's not that it's cash collateralized in any way by treasuries or some other government obligation or by Warren Buffett or Jeff Bezos or certainly someone of that
or even you,
net worth.
Even you.
Oh, yeah, or even me. You might have to chase me though.
Roderick, is it anything more than just misleading to say guaranteed?
It's evil. No, I mean, no, it's misleading. It's a terrible
I thought you said it was fraudulent before. So I was hoping you were.
Well, yeah, fraudulent. I'm trying to go even stronger than fraudulent. It is evil. Yeah, I mean, it's just, this is what happens. You know, in my business, I'm often competing for the attention of the sponsor with the sponsor's marketing team. And, you know, the marketing folks, of course, they're out there, they're selling, man. They've spent their whole career selling stuff. And for them, this is just an LLC interest, just another widget that they're trying to sell. So they use whatever words they think will work and saying that it's guaranteed. I think that my point is that the marketing person probably doesn't see anything wrong with this. He thinks he's being clever. He's not really trying to be evil or trying to commit fraud. But in the securities law world, it's fraud. There's no doubt, because, you know, you sometimes hear about a benefactor who will choose a group of, you know, elementary school students, you know, in a class, the sixth grade, typically in an underserved area, and say, I'm going to guarantee you a college education. And that's a guarantee. And so if you had a deal where you had such a benevolent person with the financial wherewithal to say, I'm guaranteeing every one of your investors in this deal a 9% return, sure, say it. That never has happened in the history of the universe, however. And so alleging that it's guaranteed, even if you can trick yourself into believing it's guaranteed, for example, I'll use I think it was Joe's example from earlier. You have a triple net lease with an affiliate of Walmart, guaranteed by Walmart. The lease is guaranteed. And so you kind of work your way through and say, well, in effect, Walmart is guaranteeing the return. So I can say it. But no, you can't. They're not guaranteeing anybody's return. They're guaranteeing lease payments, assuming, among other things, that you as the landlord haven't violated the lease. So it is not a real guarantee, and no one should ever say it. And I would be very suspicious. I would not invest if a company used words like that. I simply wouldn't invest personally.
Thank you,
Adam.
Mark.
I would add that pref equity is a complicated thing to do. And it tends to be oversimplified. You do get priority, but you have to recognize the rights of the underlying lender, and you have to plan for what might happen to a borrower that has problems. And so that's why it costs a lot, in part. And so it's one of those things. It's, you know, anybody who's out there trying to raise money and oversimplifying the investment vehicle, I would say beware, simply put.
I'm going to try and move to a Q&A. We don't have many minutes left, just a few
Hey,
minutes.
can I just make one evangelical point here, Adam? Because as you know, I am highly evangelical about the crowdfunding as a mechanism for raising capital, both because it helps people in previously underserved areas raise capital and helps American capitalism that way, and also because it gives ordinary Americans access to deals that are offered by people like Joe and Irwin. And that's like the first time ever. So, you know, we have these terrible income and wealth inequalities, and by giving ordinary people access to their deals, that can help chip away at that. But a known but unintended consequence is that investors, people are raising money, as I'm sure this yet unnamed, you know, company you've been referring to, from unsophisticated people. So it used to be that if they needed to raise money, they had to go to the sharks on Wall Street or Los Angeles or Phoenix to raise it. And those folks, I'm not being sexist, call them guys, they're all guys, they are tough and they know what they're doing. And if they see the word guarantee, they are, after they get up off the floor laughing, you know, they're not going to write you a check. So it's great. Crowdfunding is a great thing, but now we've had this influx of relatively or even absolutely unsophisticated investors. And that's why they're running ads on Facebook, right? You're not running ads on Facebook to look for private equity capital. You're looking to ordinary Americans, and they're not sophisticated, and they can be fooled. So hopefully that is a process which you are helping with, you know, Adam, with your educational series like this one. But it is, you know, all the questions you're asking are a function of relatively unsophisticated investors investing in stuff they didn't used to be able to invest in. That's my point. Exactly.
Thanks, Mark. All right, so I'm going to try and run through some bullet points here. Tom, I'm going to try and hit some of these. You're very silent over there, but let me hit you with some of these. Let's try and just do them really quickly. If anybody does have questions afterwards, I will provide contact information and LinkedIn and etc. to everybody by email. Right. So one investor says, she says like this: in another investment, I'm receiving my distributions well past the time referenced in the offering documents. For example, fourth quarter 23 not received yet, but when I look in my portal, it shows that I did receive it in December 23. Every time this happens, I call the sponsor and they tell me I do not fully understand accounting for sponsors. What is going on there? It's showing, yes, you got it, but in fact, you got nothing.
Yeah, so I don't know specifically what's going on with their specific portal. It might be an error within their portal that they're automatically it automatically shows that it's posting that you received the distribution, but you never did. What it's ultimately to come down to is on your K1 on box 19. That's where you're going to see distributions. And when you receive that K1, that will show you whether or not, for at least for tax purposes, that you've received the distributions or not. And if you do have a distribution number that differs from the amount you actually received, that's something you definitely need to contact the sponsor about. But again, just as for the specific portal itself, it could just be an error that they're posting it to your portal account, despite the fact that you've not actually received it. That could be potentially what's going on as well.
I'm generally avoiding questions from anonymous attendees. Sorry about that. But there is a good one here I'm going to ask, and only because it's tax related, Tom. If there's a foreclosure and property goes back to the bank, is there a final K1 issued for that tax year? What would it show?
Yeah, so this kind of circles back to Irwin's question before with the foreclosure. So what I was referring to before earlier in this conversation was if you were to, like, if there were to be complete loss, meaning there's no sale and it went completely worthless, which is rare in real estate, but it happens. And then, or if you sold it to a third party. What happens when the bank forecloses on it, typically there's going to be non-recourse debt, which is secured by Q&R, as is kind of referred to in the tax world. And when there's non-recourse debt, and you give it back to the bank, what ends up becoming the sales price is going to be the cancellation on debt. So the amount of debt that you're being forgiven. So that's going to become your for all intents and purposes, your sales price. And at that point, it's going to be your sales price. So the debt forgiveness less the adjusted basis. We kind of referred to that before. And if the cancellation on debt, that income or that amount is greater than your adjusted basis, there will be capital gain. Then there will be potentially depreciation recapture. Generally, there will be depreciation recapture in this instance, in this circumstance. And then this will show on your final K1. Now, where this will show on your final K1 is I have to actually go back and look specifically at a K1 where this happened to show you exactly where the boxes come in. But what's most likely to happen is going to show usually somewhere on box 2 of your K1, or perhaps in some of the capital gains boxes, which are a little bit down the K1. Like usually box 9 in one of those boxes, if that's the case. So to answer your question, it does show up on the K1. It will be on that final K1 in most cases.
And definitely, I keep saying it whenever I hear Tom talk, call an accountant, right? I have this rule, the AAA rule. For anything to do with law, ask an attorney. And if it's anything to do with tax, ask an accountant. Make sure they both specialize in real estate.
Well, if I could just add one more thing there, this stuff when it comes to partnership tax law is incredibly nuanced. So whenever we're doing this for people, we have our research up, we're dotting our T's, crossing our I's, or reversed
the way around.
Yeah, but we're doing all of that. So yeah, it's just sometimes this stuff is complicated. So if it's something you're experienced, you definitely do want to consult with a CPA.
Out right, I'm going to stay true to the time here. There's lots of questions. I really appreciate everybody sending these questions. Just out of respect for everybody's time, all my panelists today. I really appreciate you joining me. Appreciate everybody who is on the call also for joining us today. I hope you found the time well spent this morning. It's a tough market. It's a tough environment. But there's also a lot of opportunity, opportunity knocks. So if you have any questions, you are sitting in front of at least 4 experts, self-excluded, 4 experts. You should definitely reach out to them. I will send an email out to all people that registered, giving, so as long as nobody minds, right, Joe, Mark, Irwin, or Tom, I will provide your LinkedIn profile so they can contact you there. Check with you if you don't mind, emails and whatever else, company data, etc. But thank you for attending. Thank you to my panelists. It's been a real pleasure. You guys have been fantastic getting up this time to get this done today. Thank you, everybody else. And that's it. That's all I've got today. I'm gonna close things out and we'll stop streaming, and that's what we got. Have a good day. Thank you.
Thank you.
Thank you all.
Thanks, everyone.